How are credit scores used in retail banking? Imagine walking into a bank, ready to apply for a loan or a credit card. The first thing that comes to mind is your credit score. This number plays a huge role in retail banking. Credit scores help banks figure out how likely you are to pay back borrowed money. They usually range from 300 to 850. The higher your score, the better your chances of getting approved for loans and credit. Retail banks use credit scores to make quick decisions on applications. When you apply for a loan, your score helps the bank decide if you are a good risk. If your score is high, you might get a lower interest rate. If it is low, you could face higher rates or even denial. This process is part of how banks manage risk and ensure they lend money wisely. Credit scores are calculated based on several factors. Payment history is the most important. If you pay your bills on time, that boosts your score. Current debt levels also matter. If you have a lot of debt compared to your income, that can lower your score. The types of credit accounts you have, how long you have had credit, and how much of your available credit you are using all play a part too. Banks often use scoring models like FICO or VantageScore to determine your creditworthiness. In the world of capitalism and financial systems, credit scores help banks allocate capital efficiently. By identifying who is likely to repay loans, banks can set interest rates that reflected the risk involved. This way, they can protect their financial stability while still lending money to those who need it. Retail banks also monitor your credit score over time. This helps them keep track of your creditworthiness and adjust your credit limits or interest rates as needed. If your score improves, you might qualify for better loan terms. If it drops, the bank may take precautions to manage its risk. Credit scores encourage consumers to maintain good financial habits. When you keep your score high, you gain access to better financial products. This creates a system where responsible borrowing aligns with market-based lending decisions. In retail banking, credit scores are essential tools that support lending decisions and promote financial responsibility. They help banks manage risk while allowing consumers to access the funds they need. Understanding how credit scores work can empower you to make better financial choices and improve your chances of obtaining credit in the future.